Welcome to Coffee Chats with Klaas. Hi, I'm Melissa Wenger with Klaas Financial, and today I'm here with CJ Klaas to talk about required minimum distributions and what they mean for you. CJ, what are required minimum distributions, and why are they required?
Required minimum distributions, also known as minimum required distributions, apply to pre-tax retirement accounts and require you to distribute a certain amount annually to report as income. RMDs are in place to make sure some of the money in these accounts are being taxed as they've been growing tax deferred since they were established. To be more direct, the IRS only allows you to defer taxes for a limited period of time.
How do I know if I'm subject to an RMD?
For most individuals, you'll be subject to an RMD in the year you turn 72 if you own a pre-tax retirement account. This was recently changed from the year you turn 70 and a half with the passing of the Secure Act in 2019. This means a certain amount of the account must be withdrawn by the end of the calendar year in which you turn 72. Now, there is a special exception for the first year RMDs, which can be deferred until April 1st of the following year. However, if you elect to take advantage of this first year RMD flexibility, then you would be required to double up in the second year, since all of your future RMDs must be out by the end of the calendar year. For those that are curious, we don't suggest you generally waive the first year RMD to the following year unless there's a specific tax reason to do so.
What about the individuals who inherit a retirement account? Will they be subject to RMDs?
Great question, and the answer is maybe. To identify if you're subject to an RMD from an inherited account, you must first ask 3 questions. What year did the decedent die? What is my relationship to the decedent, spouse versus non-spouse? And what is the age difference between us? If the decedent passed in 2019 or before, no matter your relationship or the age gap, you will generally be able to stretch the account over your life expectancy and therefore be subject to RMDs starting the year following the death of the decedent.
What if the decedent passed away in 2020 or after? Isn't there a new set of rules established by the Secure Act?
Yes, the Secure Act created 2 sets of designated beneficiaries: eligible designated beneficiaries and non-eligible designated beneficiaries. Those who are eligible include spouses, minor children, disabled and chronically ill individuals, and individuals who are not more than 10 years younger. These individuals are able to stretch the IRA over their life expectancy. Eligible designated beneficiaries will be subject to an annual RMD starting in the year after the decedent passed away, as determined by the single life expectancy table, even if the account is a post-tax Roth account. If an individual is a non-eligible designated beneficiary, they will be subject to the new 10-year rule, requiring the account to be fully distributed at the end of the 10th calendar year. This is following the death of the decedent. Individuals are not subject to RMDs in years 1 to 9 following the death of the decedent, and therefore can distribute the account at their own pace. Special note here, if the decedent did not satisfy his or her RMD before they passed away, then the beneficiary will be required to distribute the remaining RMD in the year the decedent died. Admittedly, this can be a confusing subject depending upon the number of beneficiaries, so please contact your financial planner or your accountant for further clarification.
If I'm subject to a RMD, how much do I need to take?
This depends on which life expectancy table you fall under. Yes, as if there's not enough to know, there are 3 life expectancy tables to be aware of: single life expectancy, uniform life table, and joint life table. As we just discussed, the single life table is used for individuals who inherit a retirement account and are able to stretch the account over their life expectancy. The second table is the uniform life table and is probably the most widely used, as it computes the RMD for most individuals when they turn 72. For example, take Fred, who's turning 72 this year, with a traditional IRA balance of $500,000 as of December 31st of the previous year. His life expectancy factor, according to the Uniform Life Table, is 27.4. Fred would divide his closing year-end value of the previous year by this factor of 27.4 to equate to an RMD of $18,248.18. In simple terms, Fred's RMD would be close to 3.6% of his previous year-end closing balance. It is important to note that this factor is reduced each year, thereby generating a larger RMD annually, all else being equal. For example, when Fred turns 80, his RMD on a $500,000 traditional IRA would be $24,752.48, or closer to 4.9% of the balance. As you can see, the RMD amount grows as a percentage of the prior year ending balance as a person ages. The final table is the joint life expectancy table. And this one is used to compute RMDs for an individual whose spouse is more than 10 years younger and is the sole beneficiary.
What happens if I don't take my RMD?
Simply put, don't miss your RMD. There is a 50% penalty on the amount that wasn't distributed. One important note is that if you have multiple IRAs, the cumulative RMD can be satisfied through any one IRA. However, if your employer-sponsored retirement plan, like a 401k or 403b, is subject to an RMD, that minimum distribution must be met by performing a separate distribution from that particular plan, and it cannot be met by adding the amount to your IRA distribution for the year.
If I'm subject to an RMD, what are my options?
It's important to note that all the IRS cares about is that the money is distributed from the accounts and thereby taxed. The RMD can simply be spent or distributed monthly to help with cash flow. Individuals may also choose to reinvest some or all of the RMD into a taxable account, but the RMD cannot be converted to a Roth account. Another great option for those with charitable intentions could be to donate part or all of the RMD to a qualified charitable organization via a qualified charitable distribution. This can be a powerful planning strategy.
What are QCDs and what makes them so powerful?
A QCD allows a tax-free distribution to be made from an IRA and be paid directly to qualifying charities. This results in a powerful above-the-line deduction that reduces your adjusted gross income. This is important because you do not need to itemize your deductions to receive the benefit. There is, however, a $100,000 limit per person per year, which does count against your total RMD for the year. Lastly, it's important to note that QCDs can start after you turn 70 and a half and do not have to wait until you reach age 72. I have no idea why Congress didn't just match the age for QCDs with the new age for RMDs at 72, but I suppose that would just make things too easy.
Thank you for your time today, CJ. Join us next time for Coffee Chats with Klaas.